What's up, everyone? Welcome back to the channel. You already know, in this channel, we don't chase hype stocks. We don't gamble on lotto options, and we definitely don't try to predict the next meme stock. Around here, it's all about consistency. And today, I want to show you why selling options has become one of the most reliable ways for me to generate steady cash flow in the market and overall inside my portfolio. I'm going to walk you through a few trades that I did this week, trades on Amazon, on the Triple Q, and of course my favorite, Google. And then I'm going to zoom out. I'm going to show you exactly how this strategy is stacking up within my portfolio. So if you've been following along, you know with these trades, I'm going to show you exactly how I manage risk, how I collect premiums, and how I keep this portfolio growing without stressing the day-to-day price swings in the market. And before we get started, if you enjoy this type of content, just do me a big favor, hit that thumbs up button on this video and also subscribe to the channel. Every single week on this channel, I put up live trades like the one you're going to see here today. I show you guys what I'm selling, what premiums I'm collecting, and what my expiration dates are. I give you guys live examples. If that's something you enjoy, subscribe to the channel and come along for the journey. Let's jump right into it. So let's go ahead and start with Amazon. With Amazon, I sold a put option at the strike price of $222.50. And in this option, I collected $45 in premium. Now, some people might look at this and tell you, well, man, you only collected 45 bucks. What's the point of that? What are you gonna do with $45? Let me explain. Here's the thing. This is just one trade. I'm not trying to hit home runs here every time. I'm trying to stack base hits one after the other. Just think about it this way. If I can sell puts like this every single week on stocks like Amazon, even an ETF like the Triple Q, on Google or the S&P 500, those small premiums, they start to add up. And you know what the best part is? The best part is that after collecting my premium, my strike price that I'm gonna buy the stock at is basically even lower because you have to subtract the premium that you collected from your strike price, and that leaves you your break-even price. So essentially, you're getting the stock at an even bigger discount because you're collecting a premium to buy it at a discount to begin with. So my break-even on this Amazon trade is just above $222, and as you can see, Amazon is currently trading above 233 bucks. That's a pretty nice cushion of $11 here. So as long as Amazon doesn't fall through the floor, this contract is gonna expire worthless and I get to keep all the premium and I'm not gonna have to buy the shares. But if it does drop and I do get a sign, guess what happens? I end up buying Amazon at a discount. This is a stock that I wanna own long-term anyways. I do not mind holding shares of Amazon for the long term. That's a win-win scenario for me. Now let's go ahead and move over to the Triple Q trade and show you what I did with this ETF. And if you're new to the market and you don't know what the Triple Q is basically one of the bigger ETFs in the US stock market that is heavily leaned towards the tech side. So you're very exposed to the tech side with the Triple Q. That's why it has a little bit of a bigger swing compared to the SPY. It does move a little bit more than your traditional SPY ETF. But for me, being an option seller, I do enjoy that a lot because number one, I do enjoy the tech sector and I do want to own these shares anyway. And number two, it does give me a little bit more juice on the premiums because the stock, or I guess I should say the ETF, is a little more volatile than your basic SPY. So on this trade, I sold the put option at the $570 strike price for the Triple Q. And as you can see, I collected a premium of $3.37 per share, which comes out to a total of 337 bucks. And right now, in a matter of minutes, this contract is only worth $3.10. That's already $27 in profit just sitting here. And again, this is not a life-changing number, I get it, but consistency is the name of the game here, guys. And this is where selling options flips the script. Most people who trade options, they're buyers. They're hoping for big moves in the market. They're paying for the contracts, and 80% of the time, those contracts expire worthless. When you're the seller of the option, you are the casino, you are the house, and the odds are in your favor. Just think about Vegas. It's built on people betting small amounts over and over and over again. And the house takes consistent profits through those bets. That's the same exact model that I'm using here. Except instead of using blackjack or roulette, I'm selling puts on the biggest companies and ETFs in the world. All right, now here is where it gets fun. I got to sell a bunch of put options on one of my favorite stocks. You probably know it, Google. Ticker symbol GOOGL. All right, so on this trade, I sold 5 put options on Google at the strike price of $225. And I collected a total of $380 in premium with this trade. I want you to understand this. That is $380 instantly that hits my account as soon as this trade gets filled. My break-even price on this trade is going to be $224.24. While Google is trading at $234.34 right now, that basically gives me a $10 buffer per contract. So unless Google drops more than 4% this week, these contracts are going to expire worthless, which means I'm not going to have to buy the shares of Google. I'm just going to be able to keep the $380 that I got from the premium, and I'm going to just sell puts on this the next week to collect even more premium the following week. This is where scaling comes in. You don't have to only sell one contract. If you've built up your account size and you're comfortable with the risk, you can layer up into multiple contracts. Each one is another paycheck. And let's be real here. Google is one of the strongest companies out there. Google's easily one of the strongest companies in the market. If I got assigned, I would gladly pick up these shares at $225 per share. What I would do is I would turn right around and I would sell covered calls on these shares to continue to make more money. And that right there is called the wheel strategy. And that is the wheel strategy in full motion. So when people ask me, Johan, isn't trading risky? My answer is simple. Not if you're the seller. Look at the consistency that I'm showing right here. Every week I'm collecting premiums. Some expire worthless, some I might have to manage, and every once in a while I do get assigned the shares. But in the long run, I'm stacking income while building a portfolio of stocks that I actually want to own anyway. Compare that to day-to-day traders who need to guess every little move, or option buyers who need a miracle just to break even. Selling puts and selling covered calls lets me play defense. It lets me control risk, and most of the time, it lets me collect big profits in cash. This is not flashy, but this is consistent, and consistency beats hype every single time. Now, let's zoom out for a second and see how this has benefited my portfolio year to date. So here's the portfolio, up over $338,000 total. Right now, we're showing $41,000 in profit year to date alone, which when you look at it, it's beating the S&P 500 return this year. It's up about 14%, which I believe the S&P right now is about 9.5%, just under 10% return. And take that with a grain of salt because this is also in a year where the market's been pretty choppy. This isn't a market like we had in 2021 or in 2020. One of the biggest reasons I've been able to stay consistent and keep this green line trending higher is because I'm selling options, guys. There's no trick to it. It's because of the premium I'm collecting. Every week, I know I've got cash flow coming in from the premiums. That smooths out the bumps in the road, right? It keeps me in control of my positions instead of panicking when the days turn red. And that is why I keep preaching how important it is to learn this strategy. Selling options is the most consistent way that I've found to trade for myself. It's not sexy, it's not a lottery ticket, but it works. You're the insurance company, you're the casino, you're the one getting paid while everyone else is gambling. If you're serious about building wealth and you want to grow your portfolio without stressing every tick, every single day in the market, then this is a strategy that you should at least take a look at. Drop me a comment down below if you want me to break down exactly how I pick my strikes and expirations on a week-by-week basis. Smash that like button if this gave you some value. And if you're new here, subscribe to the channel because we talk about this stuff all the time. Consistency wins, guys. And selling options is how I'm building long-term cash flow in my portfolio. With that being said, I want to thank you guys for watching. I will catch you on the next one. Peace.